Okay, so this next part is all going to cover off exactly where your income comes from in retirement. As advisors, we get a lot of questions talking about asking the question, when I get to retirement, what am I going to receive? How much do I need? Steph's already covered the topic about how long you'll be in retirement, how much you'll hopefully have to spend in retirement as well. So what I'm going to do is just cover off the three main areas of income sources when you get to retirement. First one is basically superannuation-based income. You've heard of allocated pensions, you may have heard the word pension streams, annuities as well, lifetime annuity, term annuities. Second type of income stream you can likely have is income from things like term deposits, cash, term deposits, share dividends if you've got some shares. You may have a rental property. Anybody here got any investment property? So you're well aware of the rental income that comes from that. And the third source of income you have in retirement can come from the government, which is basically age pension. So age pension, carers pension, and also disability support pension. I just wanted to go through some sources of income. So this was a study done a while ago, asking people over the age of 60 where their principal source of income comes from in retirement after the age of 60. So we've got the four main areas, or the three I've just covered: the superannuation income, investment income, and government pension, so age pension. There's also another fourth criteria that's basically no personal income, and that's for people who are maybe over 60 and not getting an age pension or not getting a superannuation pension, or maybe relying on their spouse for their income. So if you look at the percentages of where people get their principal source of income, does anybody want to have a guess of which figure, without looking down at your sheets of the answers there, but does anybody have a bit of a guess about how many of the population over 60 have superannuation as their main source? Is it 70%? Anybody think that? No, not as high as that? Is it as low as 5%? Is it possibly 16? All right, well done. If you've looked, you don't get any prizes or anything like that. But yeah, only 16% of people over age 60 have their principal main income coming from superannuation. If we go through the rest, if we just click through, so income that's derived from, again, rental income from your investment property, cash from the bank, share dividends, that only makes up 9%. The biggest one is obviously the government pension. So a lot of people, when they get to retirement, their main source of income comes from the age pension. And I'll go through exactly how much age pension is in the next few slides. And obviously the last one is 5%. So now let's have a look at moving over to exactly how do you access your super. So Kate's spoken about ways of building your super, salary sacrificing, non-concessional contributions, all those wonderful ways of building your super. But when you get to the retirement, when can you actually access your super? This table here just basically says, well, it depends on when you're born. Looking around the room, if you fall into the category down the bottom there, if you're born any time after the 1st of July 1964, you have to wait until 60 before you can actually meet what's called a condition of release. Any time before 64, again, it's a sliding scale. Currently at the moment, the preservation is 59. If you do the maths on all that, if you're 59, you can actually start to access your super, even if you are working, which I'll cover off in a minute as well. When we get to talking about how do you access your super, if you've met the condition of release, if you've met that preservation age, most advisors will talk to you about converting your super into an account-based pension, or what we still know as an allocated pension. I'll just go through those now. So like your superannuation, your money's invested in whatever investment option you've chosen, whether it's something conservative, whether it's something aggressive, or something in between. So like your super, you've got choice on where your money's invested, and you can also choose how often you want that regular payment. So if you say, look, I'm happy to get a monthly payment, the advisor will set up your account in a way that basically every month you get money paid into your bank. It can be paid less frequently, it can be paid annually as well. You've also got the ability with an allocated pension to access the super and the accumulated balance as a lump sum payment as well. So we have this often with our client, that we've got a regular payment being paid to their bank account to pay their bills, but every now and again they'll say, I need to fix the car, or I need to buy a new car, or we've decided to go on a holiday, we've gone on a cruise, so we need a lump sum of money. So with an allocated pension, you can also withdraw a lump sum at any stage as well. One of the tax benefits of an allocated pension is that once your money is invested, if you're over 60, any money you take out, whether that's the regular pension payment or whether it's that lump sum payment, it actually comes to you all tax-free. So the way that this was in 2007, one of the benefits of having this pension stream is that the government decided to say anybody over the age of 60, once they withdraw money from super, gets money all tax-free. So it's a tax-free income. Also as well, on the third point there, when your money is invested in an allocated pension, when it grows with the market, so each year if you're seeing a good return, you've got an 8% return or whatever it may be, the investment earnings on that return are also tax-free as well. There's no taxation. If you were to grab one of your superannuation statements now and you look at the statement that says all of the money, what you started off on the 1st of July, and what it ended up at the 30th of July, one of the line items on there is one of the fees that come out, or one of the things that come out, is tax. Because that tax is levied not just on the money that goes into super that Kate was talking about earlier, the 15%, but the investment earnings within that fund get taxed at 15% as well. When that money is in an allocated pension, it can still get the same type of return, a 6 or an 8% return, but there's no tax on any of those earnings. So if you think about your rental property or your share dividends that you've got, keep in mind that any dividend or any rental income you get is taxed at your marginal tax rate. When the money grows within that investment, so again, if you were to come and look at selling your investment property, you've got capital gains tax issues, which is a good problem to have. You want to make money, you want a capital gain, you don't want a capital loss. But keeping in mind that if you have that money, instead of sitting in bricks and mortar, if you have that money sitting in an allocated pension, you can draw it at any time, you can sell it down, and it's completely tax-free. So there's no other investment vehicles of holding your wealth that is offered in a tax-free environment in that sense. Keep it in mind as well, with that table down the bottom there, that you also have to abide by the rules that basically says when you've got your money in an allocated pension, you've got 100% access to it at any stage, but over the space of a year, you have to take out a minimum amount as well. So that's a nice simple calculation. On the 1st of July, the allocated pension says, okay, your balance on the 1st of July was X amount of dollars. For the next 12 months until the 30th of June, you have to take out X%, depending on the age you were at the 1st of July. So if you're 65 to 74, you have to take out 5% of your balance over the coming 12 months. Now, whether you take that out on a regular monthly basis or whether you take it out at all in one go, as long as you've taken out 5% or the percentage for your age at the end of the financial year, everything's all good. There's also limits on how much you can actually have in a pension. You may have heard something in the news a few years ago about how much you're allowed to have in this concessionally taxed environment in an allocated pension. It's called the transfer balance cap. It's a problem if you've got over 1.9 million that you want to have. And it's a pretty good problem to have, but basically anything above 1.9 million, you can no longer have it, or you can't start your pension with more than 1.9 million. It can actually grow above that, but when you start your pension, you can be no more than 1.9. Anything more than that has to stay within the superannuation accumulation phase, which has that 15% tax environment as well. Any questions on that?
Person? 1.9 million per person, right?
Per person, yes, in total.
So you mean in total, as a couple, you get 3.8 million?
Yes. And that's the sum total of all the accounts. So quite possible as advisors, we have multiple accounts for one person for different tax reasons and so forth, but it's the accumulated balance.
My other question is, this is converted from 60 years old, and how do you actually get the money into, you have to convert all your income and into super first to convert this money? So can you contribute later on?
No, you can't contribute directly into an allocated pension. You can only contribute into the superannuation first, and then as the advisors, we transfer that across into an allocated pension. If at any stage you come into further funds or you decide that actually you want to go and add more money in, we have to basically commute it, roll it back from an allocated pension back into superannuation, contribute into super, and then roll it back into a new allocated pension. It's a little bit of a...
Also, there is a limit to an age limit when you can contribute up to the ages of 70 depending on the contribution you're making, there are certain ages that you can contribute to super until you can no longer do that. So if you were 80 years old and you came across an inheritance or some funds, you may not be able to get that into super because of restrictions. But as Kate mentioned, with the downsize of contribution, if you sell
Only after you retired, you said? Effectively, yes. You can actually have an allocated pension and not be retired, and I'll cover that in this next slide as well. But effectively, yeah, when people say, okay, I've had enough of work, I'm completely stopping, say, great, what have you got in super? Let's see about transferring that across into an allocated pension and start to pay you. Absolutely you can, yeah. And this will be the right now. It's called a transition to retirement. So we've got a couple of scenarios here. The first one is, as I mentioned before, as an example, is that you want to cut back work. You want to go from, say, 5 days a week back down to 3. You've had enough. You don't want to fully retire. You don't want to fully stop work. We just want to cut back on the amount of days that we are at work. Obviously, that means that you've got to cut in your salary as well, in your income, because work's only paying you for 3 days. You top up your income through converting your superannuation into an allocated pension. Technically called a non-commutable allocated pension if you haven't met the full condition of release there, but you can actually access that superannuation and supplement your income whilst easing into retirement and just working part-time. So the same rule applies for this transition to retirement pension in terms of the amount that you draw down. You have to meet that minimum drawdown, but instead of having 100% access to it, because you're under the conditions of this transition to retirement, you can only access a maximum of 10%. So the government limits exactly how much you can access whilst still doing this condition of part-time work. Kate mentioned earlier about having the salary sacrifice. One of this other strategy, the strategy of transition to retirement also works for clients who are actually still working full-time and they want to maximise their super contributions. Kate said before that salary sacrifice, great tax effective way to put money and build your super, but obviously that comes at the cost of you not getting as much into your bank account each pay period. So again, what we do there is we top up your income by starting this transition to retirement pension as well.